Greetings, members one and all of the Salivation Nation. A quick Google search for what caused the financial crisis of 2008 gives us a predictable result, quoting at the top of their search results a source that simplifies the issue by blaming lack of government oversight or deregulation in the financial industry. But in reality, aside from that bias, there's a lot more involved in it than that. If you dig a little bit deeper, or sometimes even a lot deeper, you'll find that really there's much bigger reasons why, and that could probably be proven to be the exact opposite of this claim. But by and large, you take that into account, you will see that there's a lot of other factors that caused or contributed to the financial crisis. And we're going to explore those because what I'm about to suggest is sort of a little bit different than what I have thought in the past. Now, I'm very open-minded on this issue because no one can really predict on what the next financial crisis will look like. I just think that most of us in this community can agree that there will be one coming soon in the form of another recession or possibly even a minor depression. But we shall see. But basically, I am suggesting that possibly the next financial crisis may be or may not be as bad. And if it is, the effects of it may not be as bad as the last financial crisis. So before we go into that theory a bit, or that suggestion, we have to take a look about what caused the financial crisis of 2008, which was a big doozy. But in reality, given folks in this country, there was a lot of people that lost jobs, lost a lot of money, but by and large, there was nowhere near the hurt that we saw during the Great Depression of the 30s. But, I'll just I'm not going to go through all of these, but we'll kind of outline some of them, and we'll give an idea to set the stage for what I think will possibly be, could happen in the future. And we're going to tie this in with silver and gold to see how they will play and how they played out during this scenario, just from a price perspective. This article starts off talking about how most people have an opinion about what caused the financial crisis of 2008 or 2009. It was securitization or greed or deregulation or any number of other things that, truth to be told, probably did play a role in an unusually severe economic downturn. But after reading a good portion of the books written on the crisis from a variety of viewpoints, journalists, regulators, and private sector participants, the author here concludes that it can't be boiled down to one, two, or even a handful of root causes. It was instead a product of dozens of factors. Some of them are widely known, others are not. And he references a book about how Washington failed America. And he wrote a list of 39 factors that played an important role, not only allowing the subprime mortgage bubble to inflate, but also in allowing its deflation to wreak such havoc. What follows is a scaled-down version of that list. It talks about some of these are pretty important and obvious. Others, not so much as was mentioned. We're going to cover a couple of them. Market-to-market accounting. Since the early 90s, the Securities and Exchange Commission and the Financial Accounting Standards Board started requiring public companies to value their assets at market value as opposed to historic cost, a practice that has been discredited and abandoned during the Great Depression. This pushed virtually every bank in the country to insolvency from an accounting standpoint when the credit market seized in 2008-2009, thereby making it impossible to value assets. And I think that is, I think that's crucial. So there is your government causing a problem. Instead of regulate, oversight, providing oversight. Ratings agencies, a financial crisis couldn't have happened if the three ratings agencies, Standard & Poor's, Fitch, and Moody's, hadn't classified subprime securities as investment grade. Part of this was incompetence. Part of it stemmed from a conflict of interest, as the ratings agencies were paid by issuers to rate the securities. And yes, we did see a lot of that going on. It's been outlined in documentaries and movies. The Big Short is one. And it's crazy how that has happened. And the infighting upon financial regulators since its inception in 1934, the FDIC has been the most robust bank regulator in the country. The others have at one time or other included the Office of the Comptroller of the Currency, Federal Reserve, etc. And but banks too infighting among regulators. But thanks to infighting among regulators, the FDIC was effectively excluded from examining savings investment banks, while the OTS's and SEC's primary jurisdiction between 93 and 2004. Not coincidentally, these are the firms that ended up wreaking the most havoc. So again, the regulators, they couldn't agree, and that's as a result of really a big and bloated government. Because when you have agencies working against each other, that's going to cause friction and inefficiencies in doing their jobs. Securitization of loans. Banks traditionally retained most of the loans that were originated. Doing so gave lenders incentive, albeit imperfectly, to underwrite loans that had a small chance of defaulting. This approach went by the wayside, however, with the introduction and proliferation of securitization, because of the originating bank doesn't hold securitized loans. There's less incentive to closely monitor the quality underwriting standards. That's right, and it's certainly something that especially coupled with number 3, you can have all the regulations written and all the strict rules that these banks have to follow, but if you're not going to enforce them or to properly, efficiently oversee them, then what's the point? Credit default swaps. There are fancy financial instruments JP Morgan Chase developed in the 90s that allow banks and other institution investors to insure against loan defaults. This situation led many people in the financial industry to proclaim an end to credit risk. The problem, of course, is that credit risk was just replaced with counterparty risk, as companies such as AIG accumulated far more liability than they could ever hope to cover. And that is one that is certainly something that we're seeing and is possibly could be happening today. I posted a video recently how JP Morgan, we don't know if they own that much, all the silver that's been claimed. And even as such, probably the likelier portion or likelier case is that they have much more of the SLV, much more paper silver out there than there is the physical to cover it. And that physical being held in their vaults is probably not owned by all of them, if they even have that much physical in their vaults, whether they own it or not. And then you get into things like ideology, greed. And greed, by the way, is not just in the financial institution. It's obviously it falls into the public sector as well as the private sector for sure. And when you were and especially home appraisers, bankers are paid absurd amounts of money to securitize toxic subprime mortgages, and many of the banks were forced to lend money to people who couldn't afford it. Predatory lending was certainly something to think about. Fraud, obviously we had fraud with the Bernie Madoff was around that same time. Short-term investing horizons, politics plays a part, obviously, as we see that along the regulators and politicians. And then bad economic assumptions, high oil prices, bailouts, rescue of Bear Stearns, which JP Morgan acquired. And these bailouts are one of the biggest things that probably, I think, has made this recovery so slow and so stagnant. And many people say that throughout these different things, you got the Fannie Mae and Freddie Mac, which is they say much has been written about the role Fannie Mae and Freddie Mac played in the lead up to the financial crisis. In short, the problem was that these two quasi-public corporations became so focused on growth at all costs They abandon any semblance of prudent risk management. And that's the key, because they were padded by government bureaucracy and allowed mortgage brokers, criminal enterprises such as Countrywide Financial and AmeriQuest Mortgage to stuff the government-sponsored entities and the gills with shoddy originated subprime mortgages. And so there's a lot of stuff going on, the shadow banking and ignorance of history. That's another thing too. And so there's a lot of different factors that came into play, but by and large, I think a lot of this starts from government creates the problem, and then the only way to fix it, these politicians go out there and say, we're the only ones that can fix it in government. So you have government that creates a large aspect of the problem, and again, there's a lot of blame to go around from people obtaining loans beyond their means in the private sector, in the customer base, to these banks who are willingly happy to loan them the money, knowing that they probably can't pay it back because they're going to make a windfall. And then to the regulators and the government itself and politicians, there's blame to go around on every front for this financial crisis that had occurred. But by and large, some of the that problem that had occurred within these different entities was sparked by government regulations, I believe. And so because people are getting through the loopholes, the infighting between the regulators and allowing these people to take advantage of that infighting in order to do some of this stuff. It's so there's a lot of things that worked in concert together and all came to a head in December 2007 and 2008. And now a lot of this problems has been welling up for many, many years, going back to when a lot of this stuff had started. A lot of these government entities and government programs and laws were enacted. But my feeling is that which helped cause the problem, why would you have more of it to try to solve it? With that being said, much of what has gone on before is still going on to some extent. And but these 25 reasons, and I'm sure there's probably more and others that you can build up from that. The only difference between then and now is maybe some things have been fixed, others have not, is we're much more in debt. We're over twice the amount in debt that we were back then. Although that may not play as big a role because it seems like it really they didn't care back then. I mean, you think about it, back then in 2007 and 2008, there was some politicians who were saying that that President Bush had brought this nation into more debt than all 42 presidents behind him had combined, and they were right. And now we're well outside of this financial crisis, and we're double that from what George W. Bush did. So there may be some padding there with the national debt, which makes me cringe to even say, but apparently it hasn't hurt us so far. But we're playing with fire because the debt and the dollar that from which is the primary debt instrument will only hold the faith of the world for so long before it comes back to bite us. But we may have some time, and that's why I think that given that and given why the other currencies around the world aren't doing as well, I believe that their last best hope really is the dollar, because that's kind of the best of all the cases. So I think that with the breadbasket of world reserve currencies out there, the dollar is the king of them all, unless there's a threat to it, and some say that there are with the BRICS nations, and I still don't know what's going on there as they're trying to somehow in some way make the yuan, the renminbi, as a standard bearer of a group of currencies that could possibly compete with the dollar in that regard. But I think that sort of talk has kind of waned a bit. But the dollar is strong nowadays. The economy is improving right now. The stock market is at an all-time high. And so if it's at an all-time high, What does that mean for gold and silver? Well, they're going low. They're very low right now in comparison. And we're going to take a look at let's take a look at the 5-year charts for gold and see where gold is now. And it's been, this chart here makes it look a bit volatile, but by and large, it's staying pretty stable here. And whereas highs, it did get up in July of 2016 here to 1361 an ounce. And if we take a look at 5-year silver, it's some of its highs were around $21, and now it's gone down. In January 2016, it went down to $13.88 an ounce, and it actually flirted with that. Almost went below $14 just a few days ago. So it's quite interesting to see, gold and silver in an economy that's growing and doing better. Gold and silver are coming out lower and depressed, which means we have a strong dollar. And but that doesn't necessarily mean it's a stable dollar. It doesn't necessarily mean it's going to last a long time. And especially when you take into consideration, where, that many of us are predicting there will be another financial crisis, another recession coming soon. Recessions on average occur about once every 9 years. And so we're overdue for it right now, in my opinion, if you go based off the average. Now that's just an average, and this, the economy and the nature of the economy is much different since the 2000s, since 9/11, really, than it was before. So let's take a look at the 20-year history. And we're going to take a look at the 20-year history for gold first, because gold is typically seen as more of a stable, preserver of wealth. It doesn't react as much as silver has. Gold tends to be more stable in its outlook. And so if you take a look at the financial crisis, before the financial crisis, starting in about 2006, we saw gold take a very steady climb upwards. Even before. So from 2006, when it started to climb at $500 an ounce, towards the end, when in 2007, a couple months before, they saw something happening, and then gold started to really climb up here. And by February of 2008, we saw gold get close to $1,000 an ounce, which is a big deal. That was a big deal back then, considering that just 2 years before, it was almost half that. So, the financial crisis did play a role, but then look what happened. You saw quantitative easing. I don't know, bailouts started happening, and it started to go back down again. And I guess people thought, well, the world didn't completely implode. It was a crisis, but it wasn't as bad as some people thought. We might get into another depression. With that being said, we could see more what I would consider natural and normal happenings here. And then, of course, we saw by 2011 what we saw, almost $1,900 an ounce, which I thought was unusual and unnatural highs for gold there. Now we've seen that it's come down a bit, but look, it's shelved out here. And so now we're essentially kind of at this period, I believe, as far as stability in the price. We're kind of sort of in the same boat again. So if we have another crisis again, I believe we will see gold and silver rise for obvious reasons that we've discussed in other videos. But nonetheless, that's going to be the new floor. And so we may see gold and silver rise, but I do believe that we'll see a recovery sooner rather than later, because of the way the government would react this time to it. Will we have another bailout? I would hope that a more conservative administration would see that bailouts and infusing a lot of public money into the problem may barely keep your head out of water, but it's going to cause, but the repercussions of doing so will be much greater, because how much more debt can we really incur? You know, Trump has added essentially $1 trillion worth of debt, you know, in his first almost 2 years in office here, and that will be added, and that's under a good economy, and really our debt should be going back down. So let's talk about that with the national debt and an infusion of more money if another financial crisis comes, more bailouts, more quantitative easing. So we saw silver kind of do the same type of thing in a sense, but these little peaks and valleys are a little bit more volatile. Same situation after the bailouts, the price did go back down to $9.46 an ounce in 2006. It was around $7-8, and then we saw the 2011 rise to almost $50 an ounce, and now we've seen it come back down. And again, silver has a much higher floor than it did in 2006 on a nominal price, you know, differential there. So but it's one of those things where it goes up from here. I don't think we'll see this again. I think that was an unnatural thing, but I think what we could see is the next peak in prices could very well be close to, you know, $30-40 an ounce in another market condition, because I think a lot of this silver price action being where it is, it's not only due to inflation and the like, but also the fact that we are in debt, and our economy, though it's growing right now, it's fragile. By all intents and purposes, the economy is fragile, because a lot of the same factors that caused the crisis of 2007, 2008 are still there. They're still there, and and so when it does happen again, it's how the government reacts. It's how you know, people react, how businesses react, and how, you know, you think about the auto bailouts. Had they not bailed out GM and others, you know, there's a lot of talent in those agencies that, as far as skills and people and what they do, they could reform. That talent is not going to go to waste. The ingenuity, the entrepreneurship in this country, if you allow it to really flourish, will recover a lot quicker, and it'll be real money instead of essentially printed, you know, money out of thin air, helicopter money. Real money, a real dollar goes a lot longer way than bailout or public money, in my opinion, or helicopter money. So if they can do the right thing when the next crisis hits, and it will hit, and I believe it will hit sometime during Trump's presidency, and I've said that even before the election, no matter who gets into the White House, we're going to see an economic crisis. I believe if Hillary had been elected, it may have come sooner. And I believe she would probably implement a lot of the same policies that probably the Obama administration and the Fed had enacted at the time. The Fed became highly politicized, and even today, you know, the raising of interest rates is to try to kind of stave off some inflation and the like. But you got to be very careful. They've got to be very measured in how they do things. But by and large, the private sector, more faith in the private sector, and how even how the private sector deals with these kind of crises, I think is going to be crucial or key here, which means that there's a chance and there's some hope if Washington stays enough out of the way that the effects of the next financial crisis may not be as bad as the last one. We can hope, and we shall see. But in any event, gold and silver will react to them. And I believe that if gold and silver, that there is another financial crisis, we will see the prices go up, not only, but also when they do subside and come back down, no matter what, even if there's not quantitative easing, there's still enough, even with normal inflation at 2%, which is the targeted inflation for the Fed wants. I believe we'll see a new floor for silver and gold. And that new floor just very well may be $20-25 an ounce for silver. And for gold, that new floor may very well may be $1,300 to $1,400 an ounce through the next crisis after it subsides. We shall see. It's going to be fascinating. I want to thank you guys for putting up with this long video, but I thought it was a subject that's worth talking about because I do believe, with all that's going on out there, especially things that most people in the news don't really think about or hear about, of what's going on in the financial markets, what's going on with the banks, what's going on in the real estate market. There's a number of little things like that going to be the catalyst for the next great recession or financial crisis that can occur. So I hope you enjoyed this video. Post your thoughts below on your thoughts on the causes, on a future financial crisis, and on where you think gold and silver will be when that occurs. I'd like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, comment, and subscribe.